In the growth of chemical industry in the country, the role of specialty chemicals is very important. It has around 20% share in the total chemical market. By 2025, its market is expected to grow at 10 to 11%. After the COVID-19 pandemic, now companies are adopting China Plus One strategy, which means setting up manufacturing plant in some other country besides China. Due to this, India is emerging as the manufacturing hub for specialty chemicals for both domestic as well as export market. Hence, the sky is the limit for the growth of specialty chemical companies in the country. But the question is, should you invest in the companies of these sectors and how beneficial will it be? To understand this, first you need to look at the performance of these companies and how they will continue to perform in the future.
However, first of all, let us understand what is specialty chemicals. This is the kind of chemical product that is used as a raw material for other industries, like for example, adhesives, agrochemicals, food additives, fragrances, lubricants, paints, polymers, etc. A lot of sectors like auto, food, cosmetics, textiles are critically dependent on specialty chemicals for producing their products. Now let us look at the performance of these companies in the second quarter of FY23. We can expect companies of specialty chemicals to continue their strong performance. Despite higher energy and raw materials cost, results are expected to remain good, which would be driven by higher product prices and strong export demand. Companies' margins will get support because fall in crude prices from upper levels have brought some stability in the chemical prices.
Now let us look at what brokerages have said. As per the brokerage house Phillip Capital, in the second quarter, the revenues of specialty chemicals are expected to go up by 31% year-on-year and profit by 43% year-on-year. Now let us look at the concerns for this sector. Quarter-on-quarter, costs of some critical inputs have gone down and for some, prices have remained stable. But looking year-on-year, jumps in costs may keep pressure on margins. Besides this, higher energy, power, fuel cost can also put pressure on margins. Coal prices are 2.7 times year-on-year and 25% quarter-on-quarter higher. But despite all of this, SRF could be an exception with a margin improvement of 1.5% year-on-year. The rupee has fallen 3% against the dollar on a quarterly basis. This will increase the competitiveness of the company's exports.
Well, we have looked at how the results of these sectors can be, but it's time to look at the outlook of the sector. Along with a fall in crude oil prices, lower input cost may lead to better margins. Besides this, rebound in demand will support the development of the sector in the short term.
Strong order flow, strong demand for exports, along with an increase in end-user demand are the reasons that KR Choksi Securities are positive on the sector.
So you have understood the sector outlook and also the brokers have given their opinion on it. We also recommend buying long-term in the selected stocks. If you are unable to decide which stock to enter, then you can take the advice of a financial consultant.